Mr. Chairman, I'd like to start by also acknowledging Mr. Tarullo's comments about the importance of capital. And I know you've given a great deal of thought to this for a very long period of time and have considered this in a very sophisticated way. And I there may be many things you and I may or may not agree on, but I think the emphasis on capital as a general matter is exactly the right direction that we ought to be heading in, and I fear that that Dodd-Frank is a profoundly misguided effort to do many, many other things. I have to respectfully disagree with our chairman, who, in his opening comments, I think tended to disagree with the characterization of Dodd-Frank, as I have characterized it, as a very explicit attempt to require that regulators micromanage banks. I do believe very much that it is exactly that, and that it is guaranteed to fail in that respect. But I want to touch on another topic, if I could. And Mr. Grunberg, I observed in a recent speech that you stated, among other things, that the quote, and I think this is within context, that the typical path toward the failure of an insured bank starts with bad loans. My understanding is, according to the FDIC's website, over the course of 2009 and 2010, there were almost 300 banks that failed in this, about 297. It's actually quite a high rate of failure, the highest since the early 1990s. 95% of these failures were banks with assets of less than $1 billion. And I would just ask you, to your knowledge, how many of them failed because of their prop trading activities?
To my knowledge, Senator, none of them.
None of them, not one. Did they fail because they made loans that went bad?
As a general characterization, I would say yes.
Yeah, like virtually 100% of the cases, it was because they had bad loans. So would it be fair to say that historically, including to the present day, the biggest risk of banking is the lending activity that's inherent to the banking process?
Yes.
Do you regulate that at all? Does the FDIC and does the OCC have any regulatory oversight whatsoever over the lending process?
Yes,
yeah.
That's a considerable focus of our examination and supervision activities.
Lots of regulation, right? Documentation.
And on-site
concentration requirements, supervision of the activities. And yet, despite that, 100% of the failures of banks in America in the last 2 years are attributed to bad loans. This is not I'm not criticizing the regulatory process. It seems to me that if we have a banking activity, the very nature of which is to take risk in extending credit, some of those banks, especially during tough economic times, are going to fail. And that is unfortunate, but it is acceptable. It's unavoidable. And the real goal of the regulatory regime, it seems to me, ought to be to just ensure that you don't have systemic risk, you don't have the failure of one or more institutions taking down the rest. And this is why I go back to Mr. Tarullo's observation. It seems to me that capital is the greatest assurance, that you have less leverage if you have more capital, and less systemic, greater ability, of course, to absorb whatever losses might occur. But instead, we're going down the direction, and this isn't, again, you're forced to implement a law that's been passed, but Dodd-Frank, to the Chairman's point about micromanaging, my understanding is there are 398 rulemaking requirements. 110 of them have been met with finalized rules. Another 144 rules have been proposed. Yet another 144 have yet to be proposed. And as we all know, but maybe all of our constituents may not be fully aware, when we're talking about rules, we're not talking about an admonition not to play in traffic. We're talking about many, many pages of very dense and complex matters that are associated with each individual rule. The Volcker Rule alone is staggering in its length and complexity. I think it's impossibility. Take one little aspect of the Volcker Rule, the exception that's applied to market-making activities. Just in formulating that exception, we have all kinds of metrics that we're going to impose, that regulators are going to decide. They're going to invent limits, for instance, on how much money can be earned from the bid-offered spread versus a subsequent market rule, how much business a market maker must do with end users versus interbank dealers. what kind of asset classes are permitted to trade, what kind of risks, and under what kind of circumstances. We have to decide whether these limits apply to an individual trader or whether we aggregate trades. It's staggering. I'm concerned that it's going to limit the ability of banks to manage risk. It's going to have a huge cost. It's going to reduce liquidity in the markets. And we're doing this while no banks have failed because of proprietary trading. Oh, and by the way, we create these arbitrary exceptions. It's perfectly okay if you do all of these, all the risk-taking you like, as long as it's in treasuries. As someone who once traded fixed income instruments, I can assure you, you can lose your shirt trading treasuries just as readily as you can lose your shirt trading corporates, for instance. So I guess I don't have a specific question about this. I'm just very, very concerned that we have created a monster that my last count between the controller of the currency and the Fed, we have over 100 examiners on the ground, I guess, pretty much full-time at J.P. Morgan alone. And that's before we implement all of these rules. Mr. Chairman, I have to say I think we've very much taken the wrong direction here, and I hope we'll reconsider when we're in a political environment where it's possible, and we'll consider capital as the essential tool to reduce systemic risk.
Senator Menendez.